afternoon and welcome to today's investor call from the heart of Munich, from Bayern LB. My name is Volker Kariot from the Investor Relations team. Stefan Winkelmeier, CEO and CFO, next to me will present you Bayern LB results 2025 and also will give you an outlook for the running year. And this will last around 15 to 20 minutes. Of course, you have in the aftermath time for questions, and we are very happy to receive some of them. But Stefan, without further ado, I would hand over to you.
Thank you very much, Volker, and a warm welcome to the investors dialed in to today's preliminary results presentation for the year ending 2025. It's a pleasure having you present, even if it's just digital, but at least we reconvene as a kind of routine once a year minimum in order to give you an update on how the group has performed over the last 12 months. Given the current circumstances and given the most recent events in the Middle East, I guess what we can assure you is that we are not just the middle of Bavaria, not just the middle in Munich. We are still the safe haven to invest in, and this proves also to be the truth for 2025 results. In an environment that is definitely challenging in generating enough revenues, keeping costs under control and while managing risks, the group has performed fairly well, leading to year-ending results as we have shown them on this highlight slide for 2025 with a pre-tax profit of around 1.4 billion rounded up, of an ROE around 10.5%, cost-income ratio below 50%. And I guess the most relevant part in this presentation, a CET1 ratio phase-in at 20.9%. And this has not been generated out of releasing risk provisions, but while keeping a conservative approach to finding the adequate level of risk provisions, where we have allocated additional 375 million to the books, mainly driven by corporates and markets and real estate. Given basically a background of very weak growth rates in our core domestic market in Germany and still a challenging market for transactions for real estate throughout the marketplaces, especially in the US. The good part of this is that our risk provisions proved to be adequate, so we could solve some of the NPL exposures in and around Munich. In the most recent past, that means we have sold part of the non-performing loans in December and early January to an investor base, and the level of provisions that we have established was well enough in order to let things happen and transactions occur, which also gives a sign of a slight stabilization of the market. And I would hope I could state the same also for the corporates and especially also for the whole economy in Germany, which is unfortunately not the case. And therefore, I guess the more important part is also looking forward to 2026, as Volker has already indicated. We would give a preliminary result estimate for 1.1 to 1.3 billion for the fiscal year 2026 as a profit before taxes, so more or less stable compared to this year. And I would shade now a bit more light and detail on our results following the slides that you see also on the screen in front of you. If you look at the profit and loss before taxes as well as on the consolidated ones, you'll see overall a profit after tax around 1.1 billion. For the last 3 years as an average, you see an ROE well above the 10, cost income well below 50, and a profit and loss before taxes around 1.4 billion. Again, averaged out, well knowing that we had a peak in 2024 and we're a little bit declining on 2025. Reason for that is that we had quite some challenges in the first half of 2025 in generating interest income. That was mainly given due to the interest environment that declined. However, it stabilized in the second half of the year, and especially it recovered fully then in the fourth quarter. So we were able to gain more profits than we were previously estimating. We have left you at the last call that Volker and the team did with a guidance of around 1.3 billion. Now we ended at 1.375, even increasing now loan loss provisions, which will come later too. If you look at the total assets, risk-weighted assets and CET1, this underlines what I stated before. This is the safe haven to invest in. Risk-weighted assets well under control, around 65 billion. We had an estimate to range up to 70 due to effects coming out of CRR3, Basel IV phasing in. We had a little bit of relief on the risk-weighted assets calculation one side, and the second part, growth was a bit slower than estimated, simply because either risks or margins were not adequate. So we could diminish it a little bit and ended then at 65.3 billion, as you see in the slide deck in front of you. Total assets around 270 billion, so more or less stable. And if you look at the lower chart on this page, Capital One, CET1 ratio going up to 20.9%, again, substantially above 2024. And capital in nominal figures up to 13.7 billion. That already includes the dividend distribution to the shareholders, and this is now showing the retained earnings that have been allocated to the capital. Earnings were really slightly lower than previous year. If you look at interest income, 2.7 compared to 2.65, a little bit below. But DKB well recovered in the second half and contributed also to a very stable development throughout the year. Fee income or commission income, as it's stated on this slide, slightly above, driven by credit cards exposure as well as by good corporate businesses, where we also gained some underwriting fees. The other components that you will see is, the one that is relevant to shade a bit more is other earnings. In the previous year, we had a substantially one-off gain coming out of the institutional protection scheme. That was not the case in 2025, and as such, it declined sharply, but still leaving us with 3.5 billion of total income on this part. In more detail, you see what I have already commented on as net interest income and net commission income, which is well within our expectations. If we move forward, I guess a slide that is for you as debt investors, a relevant part. So are we overshooting in terms of risk? No, we are not. We have things well under control, our portfolio fairly stable. But as we are a leverage play on the underlying economy, we definitely have to allocate loan loss provisions. And as you can see, we had lower loan loss provisions, especially in real estate, and substantial increase in corporates and markets. This is maybe a bit misleading, because we have allocated some 60 million almost to the post-model adjustments for corporates and markets, one side in 2025, and we had a substantial relief of loan loss provisions in 2024, also in corporates and markets. So if you would average it out, that would definitely show different figures. But so far, the good message is there have been single events in our mainly automotive book, which is not the biggest one that we own, where we had to allocate single event loan loss provisions. The rest, however, is allocated as a post-model adjustment and a reserve moving forward. So the assumption would be that good results, as we have shown in 2025, gave us the opportunity to allocate a bit more of reserves also in this hemisphere in order to manage a little bit also earnings for the years to come. For DKB, you see a decline in risks, and the risks that were allocated in DKB are mainly attributable to the bank's retail customer division. And here it's consumer lending at first. Consumer lending doesn't mean we have overshot it. We have increased the portfolio. We will have under control the vintages. We closely monitor the development of these vintages. There is no sign of a substantial risk deterioration. Unemployment rate definitely well under control also in Germany, despite a weak economic environment, but definitely supported by substantial demographic changes. And as such, there is no reason to worry. And you see overall a decline in the total loan loss provisions from almost 500 to a bit less than 400 million for 2025. Moving forward, also this is maybe a slide that you would shed a bit more light on. We'll still bear 90% of the portfolio in investment grade, have an NPL ratio a little bit declined, following also the sale of some NPL exposures that we were able to solve. And we still keep a high level of post-model adjustments amounting to 412 million now. This already includes the increase for the corporates and markets and a small decrease, especially in real estate. The good part here is, I guess I can just repeat what I've said before, generating roughly 10.5% of return on equity with a portfolio that is 90% of investment grade is still a challenge, and this would not be possible without having costs well under control. Even there is an increase. We are definitely well below the 50% cost-income ratio. However, we were also facing some administrative expenses that climbed 6% due to tariffs and wage agreements and inflation for those services that we buy in from third parties, but also driven by investments that we do in infrastructure. You well know our big investment here in Barnaby for changing the whole banking infrastructure, for bank steering, accounting, and reporting. That is the so-called Copernicus. We had again to postpone the project first go live date from the 1st of January 2026 to the 1st January 2027. This has definitely also contributed to an increase in the cost base. But also here, I guess we are confident that we manage now until the end of the year to have to go live, then at least working for accounting and for the SAP systems to be deployed. If we continue on a segmental view, no surprises here. DKB has a substantial part of the earnings. If you compare our figures to a group that is already consolidated and doesn't show DKB as a separate legal entity, but on a divisional scale, you would definitely also see different results. But overall, we are more than happy with what the colleagues in Berlin have done. And therefore, big thank you to my colleagues there, with all the customers that were again showing support, trust in DKB. They kept the volumes of deposits stable at around 100 billion, and also were able to grow loan businesses, both for retail and for corporate customers, also in DKB. And you see our segmental view on the question, are we just DKB with a follow-on or a small increase here in Landesbank? I would still say we are group, and this is an integrated part of the company as a whole. And as such, you must also see the risk analysis. This is part of a diversified approach. We have a retail funding basis, we have wholesale funding basis, we have a retail portfolio on the asset side, as well as we have wholesale portfolios. And this overall contributes to a well-balanced risk and a well-balanced earnings potential for the bank. So again, safe haven. If you look at Munich, look at us. There are other players around this place that are more reason to worry. If we then continue on a segmental view, I guess I would just repeat what I have already said. Real estate and savings banks and FIs, you see that also savings banks and FIs have contributed quite stable earnings, as well as Bayern Labor, our state subsidized business for retail housing. Both of them have contributed solid earnings quality, not to mention our precious metal business in Nuremberg, which is also part of a very solid income generator nowadays, even more as the crisis in the Near and Middle East has occurred. I would skip the tombstones and move to corporates and markets. Also here, one highlight to mention is the substantial increase in net interest and net commission income. This is the, let's say, the result of hard work of my colleagues under the leadership of Johannes Anschott. They have not just committed higher volumes, but were able to also generate higher margins on a really competitive market environment, which is good on the one hand side. And we have also allocated, as I said before, 60 million roughly in post-model adjustments, following our expectation for still a weak development of the German economy. Also here, I would skip part of the tombstones, even so we are very proud that we were able to finance up to 1 billion for the new ICE3 neo high-speed trains for Deutsche Bahn, produced by Siemens. DKB, we already shaded light on. Again, big thank you, big compliments to the team in Berlin under the leadership of Sven, Thilo, and the rest of the colleagues there. Cost-income ratio well below 40, ROE around 30. This is really impressive, and this part of the group's backbone and future earnings potential. This is also the reason why we invest there, why we have invested there, and why we will invest even more in the future, and therefore would also allocate further capital into Berlin. Central areas and others we already mentioned. This is where our group treasury results are allocated into. The same holds true for one-off payments, basically insurance, institutional protection schemes and other stuff. And again, here also allocated some 20 million in immediate profit and loss figures for Copernicus, as we have taken some administrative expenses, not to the asset side of the balance sheet, but completely written it off in 1 year through P&L. So again, proving that using the good results the bank was able to achieve in order to manage a little bit also our net earnings. This is where you should simply relax and feel very comfortable if you look at your positions that you hold, because there's a lot of buffer in between risks that could occur and your holdings. And whatever instrument, there is a substantial rate of CET1 ratio as per year in 2025 following CRE3, which is the almost 21% of CET1 ratio. That will definitely shrink, but still will be a very well capitalized bank in case of a fully loaded approach, amounting to 15.2, and also the MREL still at adequate levels. For those of you who follow us a bit closer, you should not be surprised. We were able to manage LGF ratios for the year ending 2025 at around 14%, a little bit above. So we were still benefiting from a 2-notch uplift. I would not expect to have the same ratios applied for the year ending 2026. We would still calculate maybe an uplift, but maybe not longer for the 14%, simply because it's quite expensive to keep this, and we have other capital bases, other ratios, I guess, that leave you well comfortable enough, but not heavily depending on this uplift on the rating side. Now coming to the outlook, I guess this is the most difficult part because the one that I was referring to is past, and this is more or less given. What we now look into is the future, and the future is fairly unpredictable these days, even more as we have seen again a war starting in the Near and Middle East that has substantial impact not just on energy prices, on the economic development, but even more so on stability. And stability is one of the most reasonable backbones for any investments. We have also delivery chains going through the Strait of Hormuz, coming to Europe from Asia, which is also a difficult exercise these days. So I guess whatever I state now is substantially depending on how long this war might occur. The shorter it is, the better it will be also for us, and the more predictable results are. The longer it takes, the more impact it gets in the region, and the more impact it gets definitely on energy prices. You know what Germany looks like. From an investor's point of view, we are an industrial production site, basically, and the more energy we need to import at higher prices, the more impact it will have on GDP growth developments. We were 3 years in a sequence in recession, so we were coming out slightly, also given a stimulus from the fiscal part. However, there is not a substantial productive growth, and as such, we definitely are dependent on a stable environment, mainly on energy prices and also on investment, which is currently under danger. However, and this is the big however, the bank is sound and stable. We have made our homework, we have improved our processes, and we have also portfolios we are not too much worried about. So we have 2/3 of the portfolio in mobility and energy. Overall, from a banking perspective, you know the ratings we were just shedding light on. And as such, we still are fairly comfortable with delivering profit and loss before taxes in an area of 1.1 to 1.3 billion, cost income ratio around high 50s, maybe due to investments both in Berlin and in Munich, and still a very sound equity ratio around 20%, I would say. Again, contributing to the statement I was making at the beginning of this call, that if there is a place that is called to be safe haven in Munich, then it's definitely us. Many thanks for your attention, and now more than ready to take questions.
Thank you very much, Stefan. Yeah, solid result, solid outlook. So we are happy to receive some questions. I see also some familiar faces here, so please raise your hands, and we will unmute you then. You have to unmute yourself afterwards, so it would be important that you raise your hands first, and we are happy, and please go ahead. It seems to be quite forward, Stefan. Yeah, so far we didn't receive any questions. I think it has to do with our good result, good outlook, good asset quality, I would guess. Yeah. So yes. Anyway, we are here from the investor relations team. If you have questions in the aftermath, I would say we can conclude here. Perhaps you have some last words, Stefan.
Yes, I guess these days, first of all, many thanks for dialing in. Many thanks also for showing interest in the result developments of Bayern LB, and many thanks also for the trust you adhere to us by simply investing in our products and in helping us refinancing our customer business the way you did in the past. I guess this was a very well-deserved decision, given that we are good credit rating, that we are a solid bank, as Volker was just repeating. And for any questions that might occur in the next couple of weeks, days, hours, whatever, please feel free to contact the guys from Investor Relations. They are more than happy to and will definitely be available for whatever kind of thoughts you might have. Many thanks, and I guess now it's time to wish all of you all the best, even more in these days. Have a safe day. Bye-bye.